Good morning, ladies and gentlemen. Well, the risk dial is pretty stable and the market is making new highs. But what is really interesting to me is how well we are fitting within the normal distribution of what a bull market does in time. As you can see, on average, it goes up about 40-50%, and the time is also matching. So this black line is perfectly within the distribution of previous bull markets, and nothing much is changing. The one thing that is actually interesting is the volatilities, and as you can see, it's all to do with the Qs and the SOX. So SOX, QQQ, everything as is at the 100%. And if you have a look at the stacked volatilities and the risk on, risk off percentage of volatility, it's all technology, which is rising while all the other volatilities are low. This is the technology, and basically it's telling you that it's all about the technology stocks and that they are leading, which is obvious from the performance on Friday. And now let's have a look at what the bonds are saying and why they're saying it. I'm going to make this one slightly different, this video slightly different, so you can understand what I think the boundaries in bonds are at the moment. Let's go back to first principles. So as we approach the FOMC and the QRA, which are both not this coming week, but the week after on the 31st, let's have a look at the summary of economic projections that the Fed put out and that the market is trying to front run. They are looking for a Fed funds rate in 2024, which averages 4.6. So basically three 25 basis point cuts, and then 3.6 in 2025, and then in 2026 down to 2.9. So they're looking for a full percentage point in 2025 and for another 75 basis points in 2026. You will see that the bulk of the cuts that they've penciled in is for 2025, not for 2024. And to me, that is very significant. Naturally, the market is going to try to front run it, and let's have a look at what that implies for the front end. The easiest thing to do is to use the CME's own tool. Now, it's very unlikely that the market is going to price out cuts in March. When would it price cuts out in March? It would price them out only if the PCE that we're going to get on Friday is very bad, but the odds of that are very low because the PCE is basically a derivative of the CPI and the PPI we already had. So the odds of that being high are very, very low. The market does not know when they're going to start cutting, and the market is naturally always going to advance the cuts. They are saying that their base case is 3 cuts. I have put in here a total of 4 cuts because the market is always going to be ahead of the Fed. I've put in 10 basis point in March, priced in, 15 basis point in May, and then certainly a cut in June, a cut in September. I don't think they're going to cut in November because that is election time, and I don't doubt that the Fed is going to go then, and then another further cut in December, which shows you that the front end this year is probably still 15 basis points too high in total, but it's not high for 2025. If anything, it's actually low for 2025. And unless those cuts start being priced out in 2025, the belly of the curve is really unlikely to go very far. So what I'm saying is that 1 year might be rich, 2-year far less so, and 3 to 5 years is not rich at all. That is where the market is at the moment. And I doubt that these cuts are going to get priced out unless we get something very clear. And Waller actually made it clear to us what he is looking at. He is looking at the revisions for inflation that will come out in February, with the CPI in February. So it's unlikely that the market prices out this cut, this, just below 50 basis points cut in March and something in May, until and unless the CPI in February is with the revisions, and especially looking at the revisions, because Waller told us in plain English that he will be looking at the revisions to give him the green light for cuts. In that case, these probabilities of cuts are not going to get priced out, and we have basically a 10 basis point down move in K4, and whatever that is, a 15, 18 basis point move down, but that is all you can get in M4. This will not be priced out until and unless we get a very clear signal from the revisions for 2023 to inflation. Waller will give a green light for cuts, and probably in May, so I can bring this up to May if the revisions are fine. I don't think the economy being good is going to make any difference to that, because he has told us it's all about the Taylor rule, it's all about real interest rates. So the odds of much more than 10 to 15 basis points higher in short-term yields is very, very low. This week we also have the ECB, of course. They're not expected to do anything, and I think they're going to pour cold water over when the cuts are going to start, and they're going to be very conservative, but I don't think the market is going to believe them. I am going to wait, and I hope they're bearish, and any kind of level here around 234 to this 50% retracement at 236, so within 2 basis points, I am going to buy the shit out of bobbles. I think that the market is going to be ready for a rapid move back down to these levels after that, and the risk reward in the short end, i.e. the belly of the curve, 3s to 5s in German curve, is going to be a wonderful opportunity to get on board with a very, very high risk reward. The 2s probably less so. They probably need to go up to something around 280 to 82, but the 5s, I think, at that level are going to be a huge bargain, and that in terms of futures is just above the 117 level, 117.00, anything 117.00, 117.15, I think is a great opportunity over the course of the next week. I keep on looking at Italy over Germany, and the fact that it just can't rally tells me that the market wants to extend and pick up yield. Until and unless this starts taking out 172, I think the market is telling you that everything is well, that there are no worries of higher yields, and that the market wants to, as I said, extend and pick up yield. It wants to invest in the high yielders because it does believe that there will be cuts, and that these are the last opportunities to get a pickup of 160, 170 basis points over bonds, because bonds will rally as well eventually, and therefore you pile into Italy. So I'm watching this like a hawk, because only moves that start going up here are going to tell me that the market is in the slightest bit worried that this, what we've had over the last couple of weeks, is just not a normal correction from yields which went just too far and priced far too much, because that's the way the markets behave. They always, go far further than they should, and then they retrace. So to me, this move in the Bund is a perfectly normal move for something that we exaggerated. We should have basically stopped here, but we went further, and now we are going further the other way because we have to retrace. But to me, Bunds around 241 are going to be a huge bargain. And the risk reward is, I think, best shown by the French market, the OATs. If you see anything near 296 after the ECB, you're supposed to buy it with both hands. And that is only 14 basis points from here. The risk reward at 296 in OATs is absolutely overwhelming. The only thing that could make me change my mind about bonds and bond levels, and the fact that the risk reward is overwhelming at levels for rallies in bonds, because the market won't price out cuts, expected cuts in 2024 and especially 2025, is if the commodity sector reversed. And that is the risk of some geopolitical event, oil primarily, I guess, but commodities as a whole rallying substantially. We're just not getting that. We are, with all the risks that we currently have, and they are quite big, aren't they? And we know that they exist. We are just slowly holding this 25.75 level, which I think is all important. And we can't even finish the week green. To me, this is very weak behavior by the commodity sector, given what we are experiencing in terms of disruptions to shipping, etc. If the commodity sector as a whole can't rally, then why should we be terribly worried about bonds? And that is reflected in oil. As long as it remains within this 75 to 69 area, and it keeps on being very stable within there, I really don't see why we should be worried about bonds. It really needs to start breaking up there and closing in this kind of area, 76, the 78 plus, for us to start even getting remotely worried about bonds. Until that happens, I continue to believe that the risk reward in bonds at levels is to buy them, because the cuts just won't be priced out. I think the market would have no reason to do that. Inflation is going to continue to head lower, and they keep on telling us that that is all they're going to be looking at, and real rates. So until and unless that happens, I will continue to believe that bonds are buys at levels. And even copper, which should be a leading metal if we're going to get some kind of a big expansion or something, is really doing nothing. I mean, this is a weekly chart. It's just basically trading within a very narrow range. The 200 period moving average is still going up. It's telling me that we are unlikely to break down completely, but rallies are very, very shallow and caught very nicely by the moving averages. So there's nothing really to worry about. And as long as there's nothing to worry about from copper, it's unlikely that DBC is going to start leading. And if DBC doesn't lead, then oil is doing nothing. And with all this geopolitical turmoil and these indicators being so quiet, just tells me that the danger to bonds is really not that great. Gold is also as quiet as the grave. I think it's unlikely that it starts breaking down below this 1980 level, and even 2010 held it fairly well last week. I think the danger is again that you a little bit to the upside with bonds, and any kind of move back down below 2000, I think it's a dip buying opportunity with some call spreads for moves that return to the mid 2050s or even up towards 2100. I think it's in a quiet range for the time being, and it's certainly not going to move a lot until we get the QRA and we see the reaction from bonds. And I would have thought that until the 31st, the danger of a breakdown below 2000, which sticks, is very low. And therefore, buying the bounce at around that 2000 level makes a lot of sense to me. The dollar is also very quiet, and the interest rate differentials are not doing very much, and therefore I don't see any reason to trade the dollar because there's absolutely nothing happening. Technically, I think we are very, very unlikely to go above this 104, between 104.10 and 104.50 area. Very unlikely indeed. And I really see no reason at all to sell it below 102.40 or something like that for the time being. I don't think the ECB is going to be able to move it very much or sustainably, let's say. And if we have a look at a Euro chart, you are trading around a very flat 200 period moving average with very, very little impulsion. But, the upside is slightly favored to the downside. And that's all you could say. And I think that the odds of making a killing by trading Euro USD in the next week are very, very low. And I don't think the ECB is going to change that fact. I really can't see what they can do or say that is going to persuade the market that they are going to be more hawkish than the Fed, or that they are not going to lead the Fed. To me, up here it's a sell, and down here it's a buy. It's still very, very much in a range, and I don't see any reason why it should break out anytime soon. In equities, it's all about the semiconductors. This is a classic risk-on, risk-off chart, which is the semiconductor index over the Japanese yen. So as you can see, we are breaking out, we've broken out, and we are going higher subject to some consolidation, but we are definitely going higher. And QQQ TLT has broken out from the previous highs. It's been in a consolidation range for the best part of over 3 months, and it's breaking out. And it's breaking out against everything. So QQQs and SOX especially are breaking out against everything, while what hasn't broken out is SPY TLT. It's still within the previous range. So that basically, it tells you what you already know, and that is that the leading sector is the technology sector, and that it's taking everything higher in the equities field all by itself. So now that we know that it's all technology, let's have a look at NDX. And the interesting thing is really the monthly chart, because it's broken on everything else. It's broken to the upside, and therefore I really don't see what resistance you can possibly draw apart from the one above the Bollinger lines on the monthlies, because those never last. And as you can see, the upper Bollinger is at 17,515 on the monthly, which is only 200 points from here, and the way it trades, 200 points it does in an hour. What I'm saying is that above 17,500, it's terribly unlikely to be able to sustain it. And really the risk reward when we have the QRA on the 31st, which is going to hugely influence bonds. And of course, I'm going to talk about the QRA next week with all the triggers. What I'm saying is if you see it above 17,500 and you have, like me, I mean, I have a lot of technology stocks and so on. What I'm going to do is I'm going to do call substitution. I'm going to sell it and buy calls. Or naturally, the same thing is to buy puts. It makes sense to me at that level, 17,500 in the NDX over it, to look to buy puts to protect any assets you have. And the same will apply for SPY, and let's have a look at those levels. Let's first have a look at the clean chart, and as is obvious to anyone, we have broken out above the 47.96 level, and therefore we are headed higher. The only question is how much higher, and then the question is what is going to be the technical retracement when it's overbought. Those are really the only questions that you have to ask yourself. So here is the monthly chart, and the Bollinger Band, the upper band, is at 48.51, and we close what, 48.39. You know, you're talking about 0.5% higher, and that starts becoming unsustainable, because it always within a month trades back. So you're looking for it to clear that Bollinger Band, go up another 0.5% from there, where you're talking about 48.70, and there you start doing some call substitution, or you start doing put spreads, looking for it to trade back down to this kind of level, 47.64, and bounce off it at some stage over the course of a month. So what I'm saying is that it's getting to unsustainable levels, and that the risk reward before the QRA, because we don't know what the QRA is going to be, and therefore if Janet were to really increase the amount of coupons, which I think is unlikely, then the long bond and the 10-year are going to have a 15, 20, 25, 30 basis point move. And that is naturally going to panic equities into a brief and sudden sell-off. So what you want to do is you want to hedge your portfolio, because it's really going to be worth doing it. The odds of the market sustaining above the monthly Bollingers and never retracing over the course of the next monthly bar are very, very low. It has hardly ever happened. And therefore, that is the risk reward. You can't really be bearish any stock market while the Nikkei is in trend. It is. So any kind of bearishness on the US is going to be a technical kind of bearishness, i.e. it's gone too far, too fast, and needs to come back 1 or 2%, and people need to be squeezed out of complacent positions that they've put on at wrong levels. But that is it. I really don't see the Nikkei doing very much, and certainly until and unless it starts closing below 34,100, 34,200, anything that happens there is just going to be a normal retracement. And the one that is actually showing you that not everything is rosy in the world, and it is all tech, is the stocks, which really, it keeps on closing down actually, and it closed down on the week when everything else went up, and went up very strongly. I think it's unlikely to close below 43.66 at any stage, and that is the kind of level that you want to buy it, between 43.83 and 43.66. That represents value, and it's unlikely to go below that. But it has very little impulsion at the moment, and it's just showing you that Europe is the weakest of the lot. And if Europe is the weakest of the lot, what are the odds that the bunds are really not a buy at the levels that I showed you, and the bobble is not a huge buy at that level that I showed you? I think, everything triangulates that those are great value levels for the medium term. The one chart that actually tells me that it would be prudent to get some put spreads on board in the SPX once it's exceeded those monthly Bollinger Bands is this chart of VIX. And as you can see, it has not made a new low with the market making a new high. In fact, it hasn't even filled this gap. What I think is likely to happen is that you get a little bit of excess in Monday, Tuesday of the SPX going above those monthly Bollinger Bands, and you get this close, but then you get this divergence that we're not making new lows in the VIX, and then the VIX goes up, spikes up with next week late or the week after with QRA and the FOMC, and you get this divergence, and that actually smashes the equity sector down a couple of percent on a technical reaction. That's possible, right? And I think that VIX is not a sell down here. I think VIX is a buy, i.e. if I think volatility is a buy, then I think it's going to be a volatile market, and it does make sense to put on some put spreads as protection, as a technical protection for something that might happen to the market over the course of the next 3-4 weeks. It's a technical thing. I don't think it's the end of the bull market by any stretch of the imagination, but it's just become too easy for the tech bulls, hasn't it? And with that, I've changed all the levels, but I think what you're looking for is you are looking for the levels to buy. Bobble, the Shats and the Bunds, you're looking, if the ECB gives us those levels, great, we shall buy them. And also you're basically looking to pick up 3s and 5s as the market allows. That is just about it. And in SPX, you're looking for those exceeding those monthly Bollinger Bands in NDX and SPX to do some put spreads, which should prove profitable at some stage over the course of a month or so. Next week, I'm going to do a QRA special with triggers, and that is going to be a very important event that is going to determine to me the shape of the yield curve for the next month or so, and that is going to absolutely have an impact on the value of all assets. Thank you very much indeed, and tweet to you tomorrow.